Hello, hello.
Hey Todd, you good? Oh, you want me to go ahead and
Yes.
show it?
Well, I mean, so okay, yeah, you can show it.
Okay, I don't know why I'm getting stuck here. Hold on. Oh no.
I can run my mouth for a couple of minutes. Um, Hopefully everybody's doing all right. There's a lot of confusion still around market structure. So I normally look at the Pips of Persia market structure. Did me wonders, but there are some newer videos that may help uh, people see it differently or see it better. I still am a fan of the line chart if you're confused or if it comes down to the nitty gritty. But in my opinion, you're just not going to find the level of success that you may ordinarily find if you don't understand uh, what a pullback is versus a change of character or shift, market structure shift. It's funny we have all these added terminologies that have been added since I started trading in 2020, and they mean the same thing. But as we get more and more people who find success in trading, uh, instead of using the terminology that they learned with, they use a different set of terminology. But the market structure is going to be the crux of your trade setups, right? Is going to be the difference between you understanding what a pullback is versus a change of direction, and then you trading based on that knowledge. So the video uh, that we'll watch today is about 39 minutes. It's also more than one series, but we're only going to watch the one, and then we'll watch the other one next week. Um, but it's designed to kind of help you see the same way that the Pips of Persia video did for me and a few other people, but uh, it's designed to help you see when we're changing directions versus we're just pulling back.
Todd, I'm getting a spinning wheel when I go to I
On the
probably
video,
probably need an update too. When I go to YouTube.
all right, let me look.
Higher low. Now,
All right, alert. Okay. Yeah, maybe you need a computer update. Mine took 20 minutes.
Try it later.
All right, can y'all see my screen?
Yep.
YouTube, how are we doing? Right, let's not muck around. Let's just get straight into it. So, in this video, I kind of want to talk about something that has probably made probably one of the biggest sort of differences to my own performance, but also really just kind of simplifying and making my trading strategy as mechanical as possible. And as you probably guessed by the title of this video, that is having a mechanical system for mapping market structure. Now, no matter what strategy you trade, whether it's smart money concepts, supply and demand, EMAs, Fibonacci's, harmonic patterns, all that shit, right? No matter what strategy you trade, if you apply the concepts that we're going to go through in this video and potentially the next few videos, I can pretty much guarantee you three things. One, you are definitely going to boost your strike rate because if you're mapping your kind of market structure the right way and consistently, you're going to find yourself on the right side of the market a hell of a lot more times than you're not. You're going to skyrocket your average reward to risk ratio. pretty much because you're going to be able to manage your trades a hell of a lot more effectively. And that's kind of for two reasons. So one, well, you're going to know, where to target. But two, you're going to be able to hold those trades with just a lot more confidence to those overall targets as well. And then kind of the third outcome, I think you'll really get from this is just having that extreme clarity and kind of, yeah, just confidence when you're looking at the charts, because when you map it this way, you're going to know exactly, what the market is doing, and what you're looking for straight away. As soon as I hop on the charts every single morning, the market structure is the first thing I'm looking at. I follow that mechanical system for mapping it, and it just makes everything a lot more easier and more simple, and everything just kind of follows on from there. Now, kind of originally had planned to do this as like like a 6-part mini series or something, like 10, 15 minutes each long. But if you can't concentrate for sort of 34, 40 minutes, probably not going to make it, bro, as the crypto fanboys love to say. So what we're going to do is we're going to rattle through a little bit of theory first, and then we're going to hop on the charts and obviously apply that theory to price action and get a bit more practical. So kind of just want to kick things off first with this weightlifting analogy that I came up with that I kind of like. And yeah, if you haven't if you don't recognize this movement, it's essentially an Olympic weightlifting movement called the clean and jerk. Now, when you see an athlete perform this, it looks like a reasonably, well, not simple, but quite a fluid, clean movement where they're essentially just lifting the weight off the floor and getting it above their head, right? Now, I think this is quite a good analogy for training, because when someone is kind of at that pro level and they have simplified the strategy into something that makes sense to them, when you see them perform that, right, it just looks like they're clicking buy and sell and it looks relatively effortless. But actually, it came from understanding or having quite a complex understanding of the complex parts that goes into that one fluid movement, right? Knowing how to deadlift, the clean, the front squat, and the overhead press. Everyone wants to just jump into the fancy stuff, doing the front squat or getting that weight above their head. But if you haven't laid that solid foundation, doing the deadlift, just doing the boring stuff, right, just picking the weight off the floor, none of that other stuff that follows on from then, is gonna work. Or you might be able to do it initially when you've got fuck all weight on the bar. But as soon as you start to put serious weight on there, if you haven't nailed the deadlift, if you haven't absolutely nailed your technique, what's going to happen? Well, you're either not going to move it or you're going to pull your back out, right? So I think this is a pretty good analogy for trading, that if you nail market structure and if you really have a solid way of doing that you can consistently map it, everything within your business will follow from there on, your trading business, right? Supply and demand, liquidity, whatever confidence you use in your strategy, entries and management come last. First, you need to build that solid foundation. So that's kind of my little rant for kind of trying to drill home the importance of of just why I think nailing market structure is so important. So I'm going to hop on the charts now just to go through a little bit more theory. Probably should have warned you, yes, my charts are white. So if you are sitting in a dark room, then yeah, apologies to your retinas that have probably just been burnt. But so some of you are probably rolling your eyes at this point. Yes, this is very basic. Bear with me just for 5 minutes. I promise you, you will learn something, hopefully learn something new in the next few minutes or so. So yeah, like I was saying, we'll rattle through this theory pretty quickly and then we will hop on the charts and do a walkthrough on price action. Now, hopefully if I figured out how to do this, there should be a PDF, I guess, scrolling on the screen maybe. And basically, yeah, I'm going to put this together into PDF, all of the charts that we're going to go through, and you guys will be able to download that for free. There should be a link in the description box somewhere below if I figured out how to do that. So yeah, we'll go through this pretty quickly, and then we'll hop on the charts. So basic market structure, kind of what you learned day one, right? Baby pips. What is a bullish market? Well, a bullish market is very simply defined by price making a series of higher highs and higher lows, right? So bullish order flow, you're going to keep seeing price making those higher lows. Each low is staying intact and it keeps printing a higher low. Now, every time price takes out a high to form that higher high, we get what is called a break of structure. So kind of just annotated that as boss, right? So price moves up, it forms that higher high, it pulls back to form a higher low. It then breaks that high, so we get a break of structure, that high to then form that higher high, then we pull back to form a higher low, right? Pretty basic stuff. Now, that's kind of if the market moved in a nice utopian sort of fashion, but obviously in reality, it's a little bit more complex than that. So this is a bit more of a realistic example where when price goes on, it breaks structure to form that higher high. It can have a bit more of a complex movement. So the way, or I guess the most important thing probably out of this entire video would be nailing where your swing highs and your swing lows are in structure. If you can get that right, everything else pretty much will follow from there. So let's say we're in the live market, we see this high get taken, we get a break of structure, form a higher high. As price starts to pull back, you can then mark out where your high is and you can mark out where your most recent swing low is. Now, everything within that high, that orange line, and that low, that orange line, right? Everything in between there is just internal structure. So the whole time price is, pulling back, it's breaking highs, it's breaking lows. Price is still bullish. We're still within the swing high and the swing low. This is all just what I call internal structure. Now, when price finally breaks out through that high to form that higher high and we get that break of structure, we want to look back and we want to know where our new swing low is, okay? Now, some people would say this is their swing low, some people would say this is their swing low, but the way we're going to do it, nice and mechanical, is a swing low is the lowest point that caused the swing high, okay? So when we see this new high being formed, and we know that's the new high, our swing low is the lowest point that caused the high, which in this case, as you can see, as I've already marked, that is the swing low, okay? Now, again, this might seem pretty basic, but as we start to apply more kind of complex steps to this, or we start to look at multi-time frame analysis, especially in the live markets, you can sometimes get a little bit lost. So it's just really important to then nail where the next range you are playing within. Okay, so then price can pull back to form that high low before we get that next break of structure. Now, the reason why this is so important is because what you'll see a lot of people do in the live market is they don't kind of paint the story well enough, they don't go back far enough in price action. And when they're trying to define their swing high and their swing low, what they do is they're actually way too zoomed in on price. If I can actually get this to zoom in for me. And let's say they're just looking at this section of price action here. And they go, okay, what I can see is price is making a series of lower lows and lower highs, and it's pulling back to form a lower low, a lower high, and now it's broken and it's formed a lower low, right? And they're just looking at this section of price action in the orange line, right? So then as price is pulling back up to this level, maybe there's a supply zone they trade from, maybe it's a resistance zone wherever you trade, and then they try and get short from here, right? Whack on, okay, that's going to spaz out for me, but whack on their risk reward tool, and then boom, they get smashed, right, as price moves up higher, and they're sitting there scratching their head going, well, price was moving to the downside, it was making lower lows and lower highs, I've got short, I've just been spanked. Why is that happening? And they go, oh, maybe that was just, down to probability. But actually, it's because you're on the wrong side of the market and you haven't mapped your swing highs and swing lows correctly. And you're trying to trade that internal structure and you're trying to trade against the actual swing trend there. So yeah, it's pretty basic, but you'd be surprised at how many people who have actually been trading for quite a while can get their structure mapped out a little backwards sometimes. So that's kind of the main points I wanted you guys to take away from this sort of first little bit. Swing high is just the highest point. It was vice versa on the bearish stuff, right? The swing high is the highest point. So let's say this high, that caused that low. So then when price forms that lower low in a bearish market, that becomes your next swing range. So price can pull back as deep as it wants, right? It can come all the way up to this orange line, but as long as it doesn't breach that line, as long as it doesn't form a higher high, as long as that lower high stays intact, then we're still in the bearish market and price can then go on to make that next lower low, okay? Then again, everything that's in between that low and that high, that is all just internal structure, okay? It's not swing structure. And the final point is, again, a very simple one, but after a break of structure, we always expect a pullback on that time frame. Pretty simple, but you'd be surprised at how many people in the market, let's say over here, right, they see that level go, they see that high go, they see price form a higher high, and the minute they see that level go, then they start thinking about buying. They think, okay, well, we're forming a higher high, we're bullish, that's a sign of strength. Let me get in long here. But actually, the smart thing to do is when you first see that break of structure, that's when you need to, in your mind, start thinking the opposite and go, well, actually, now I'm expecting a pullback. So now I need to think about that and adjust accordingly, right? Whether you want to short and play the pullback or whether you need to manage, etc., etc. So on to the next thing. Very, very simple stuff here, but this is the concept of strong and weak highs and lows. So what easiest way to think about this is what is a low's job? Well, a swing low's job is to make a swing high, if you think about that, right? And a swing high's job is to try and make a lower low, okay? So lows want to make highs and highs want to make lows. Now, in a bullish market, that is where we have a series of strong lows. So the way to think about this is a strong low, this solid blue line, because it went on to form a high. It went on to form that higher high, so it did its job. Now, when price pulls back, this high where the pullback initiated from, right? If it doesn't take out that strong low, then actually that means it's a weak high because it's failed to do its job. That high has failed to make a lower low. So if you get in long here, right, you can then target that weak high, that dotted high, because it's failed to do its job. So now we get in the bullish market, we look to get long, and we target that weak high, okay? Exact same thing. As long as it pulls back and it doesn't take out that next strong swing low, we now know that this is a weak high. So if we are in any longs here, we can target that weak high, and then we can try and target that high there. So hopefully that makes sense. Exact same thing in a bearish market. Not going to go through that just for trying to keep this video at a reasonably short length, but that's kind of as simple as this concept is, but it's a powerful one, because if you're getting in long here on these strong higher lows and you're going, okay, where am I going to target? Well, you can start to target that weak structure. This is a weak high. Why? Because it failed to take out the low. Okay, it failed to do its job. This is a strong low in theory, right? So we should try and target that weak high, so on and so forth. So if you think about it, really our goal as traders, if we're trying to trade those easy trades, trade those continuations, our goal is to catch higher lows in a bullish market, right? We want to catch all of these strong lows, and we want to catch lower highs in a bearish market, right? We want to be trading from here and then targeting those weak lows, right? That's kind of the simplest way to think about it. So like I was saying here, right, let's say we're in this bearish range here. We've had that break of structure, price is pulling back. At this point, we know that this is a strong high because it took out the low, it did its job. So in theory, price can pull all the way back up to that pull all the way back up to the high. But because it's a strong lower high, price should not breach it. And kind of another way you can think about this is that it took a hell of a lot of money for price to actually move down and break that low. So I guess you could think there's a vested interest in that high being protected and price not trading above that high, right? So what that does is we can build trade ideas around that, right? It gives us a hell of a lot of confidence to look to short from here and target what? Target that weak low. Why is it a weak low? Well, because it failed to do its job. It failed to take out the high and it failed to form a higher high, right? Super simple, but it just gives you such a clean framework for kind of mapping the structure and knowing where to target. So trend changes. Obviously, bullish market doesn't last forever. Bearish market doesn't last forever. Well, especially in Forex. Maybe if you trade crypto or the stocks, it's just bullish forever. But yeah. Anyway, so we have a bullish market. We're making price is making higher highs and higher lows. Now, at this point here, right, this low, in theory, is a strong low because it did what? It took out that high and it made a higher high. So it did its job. But at some point, what's going to happen is price is going to break that low and it's going to go on to form a lower low. So when price was pulling back, we expected this to be a strong low. The expectation is that bullish trend will continue, right? So we should expect price to do that, but obviously hasn't. The bullish expectation has failed and price has now formed that lower low. So we're now in a bearish market, okay? And that's what this dotted line shows. It just shows where that trend change occurred. As soon as we break this level and we form a lower low, for me, that is now a bearish market. Now, some people, what they want to see for a confirmed trend change is they want to see both a lower low and a lower high. Okay. And the reason why that is because what can happen is you can get a trend change, price can form that lower low, but it can be a false kind of signal and then price can continue upwards. And what it turns out is actually it was just a liquidity grab. It was just grabbing the liquidity behind this low to grab that and then continue the bullish market. So that's why some people, they don't confirm a trend change until you get both a lower low, so that move there, and a lower high, right? So they need to see the lower low and the lower high. And remember, we never know where that lower high is going to be until it takes out the low, okay? So for those people to have a confirmed trend change, they would need to see a double break of structure because they would need to see the lower low, price pull back to form the lower high, and then obviously it needs to break structure to form or to confirm where that lower high is. Okay, now, so for me personally, I don't need that much confirmation. The way I keep my trading super simple is the moment we get that lower low, that swing lower low, that for me is a trend change. And now I am looking for that lower high to form to continue that bearish move, okay? So when we get that lower low formed, if you think about the strong and weak highs and lows concept, what has happened? Well, a strong low was taken out. So that means a lot of money had to step in somewhere in this leg to form that lower low, right? To form that trend change. So in theory, this should now be a very strong high because it took a lot of money to cause a low. So if you think it's a protected high, right? There's a lot of money, has a vested interest in price now not trading higher than this high. So when we form that trend change and price is pulling back, what we can now do is build trade ideas around this, right? Because we can start to look to get short, and we know that price should not really, in theory, trade higher than this level here, right? This line here. And then if we do get short in here, where do we target? Well, at minimum, we want to be targeting that weak swing low. Why is it a weak low? Well, because it failed to do its job. It failed to take out that high, right? So this is really simple stuff, but it's literally how you build just a solid foundation for your trading. And then very, very quickly, right, we get a bearish market and then eventually we'll form that higher high. A lot of money stepped in to take out that strong lower high to form that higher high. So the bearish expectation where we would have expected the lower high to form, that has now failed. We've formed a higher high. So then we can look for the pullback and we can try and catch that higher low because this strong low should be protected and we can target this weak higher high because it's failed to do its job right. And then boom, we continue that bullish market. Okay, pretty simple stuff. Now, something called change of character. I don't really like the term. It's a bit of a fancy name, but all it essentially means, it's similar to trend change, but it's not the same. So for a trend change, we're looking for the swing highs and lows to be taken out. For a change of character, it doesn't have to be swing structure. It can just be that internal structure. So there's little minor movements in between. That is what we're looking for a change of character. So it's the first sign of weakness or the first sign of strength, essentially. So imagine you just got some nice small little price movements making a series of high highs and high lows. The first time you see that high low fail and we get a lower low, that is your change of character. Okay, generally we're applying that to the internal structure between the swing highs and swing lows. That is what we call a change of structure. Then of course eventually at some point that series of lower lows and lower highs, eventually price will break up and form that first higher high, right? And that is essentially what you call a change of character. It's basically bullish structure changing to bearish structure and vice versa. So a bit of a subtle difference to trend changes, but you'll see how we apply that now. So if you kind of look at this very basic sort of continuation, price model, whatever you want to call it, price makes a nice swing high, it pulls back to form a swing low. We then get a break of structure, so we form that higher high, okay? Now, when we get a break of structure, what do we expect? We expect a pullback on that time frame. How can we know when that pullback is about to start? Well, there's a few things we can use: supply and demand, liquidity, all these other things, which we'll get into in a minute. But for this video, we just want to look at structure alone. So how can we know when that swing run is over and that pullback is about to start? Well, this is where change of character becomes really handy, where essentially this is all one swing leg up. Okay, so we're now playing within this next range, and we want to know, can we play that pullback, right? So if we see this minor low here get taken out, and we get that first kind of sign of weakness, that change of character where that minor low gets taken out, and we get that internal lower low, now the internal structure is bearish, and that is in line with trading a pullback, right? So now we can trade that pullback. Now, how do we know when the pullback is finished and that higher low is likely to have formed? We then get a bullish change of character, okay, where that internal lower high gets taken out. We then form an internal higher high. Remember, the whole time the swing structure is still bullish. That has not changed. We're just looking at the internal structure. So everything in here is internal structure. We're just looking for that to switch from bearish to bullish. And that basically just allows us to anticipate when the pullback is starting and then when the pullback is finished. And then when we get that internal structure to the upside, we get that change of character. Now we can look to get long and target what? Target that weak high. Why is that a weak swing high? Well, because it failed to do its job. It failed to take out the swing low. So just to keep this as simple as it needs to be, we look for those internal changes of character to help us know when this swing run has ended, when we can then start to anticipate the pullback, and then when we can anticipate that pullback has now finished, and we can anticipate that high low is formed, and we can start to target that next swing high. Hopefully that makes sense. Now, what I want to add is changes of character are not the holy grail. Obviously, they can give you false signals, and that is why you need to pair them with other confluence that we're going to look at right in the next few videos. So again, we get that swing movement up. We see that change of character, that first sign of a lower low. Okay, pullback is now starting. It stays bearish, but then we get a bullish change of character where we get that first internal high. Okay, maybe now this tells us that the high low is in place and we can target that high. Price tries to do that, but then what happens? It fails to do so, and now we get another bearish change of character, okay? Because now we've got another lower low. So the internal structure has now switched bearish again. Okay, maybe that means we're going to have a deeper pullback. So we pull back deeper, wait for a bullish change of character. Okay, now the internal structure has aligned bullish again. It's back in line with the overall swing structure. Okay, now maybe the high low is in place, and now we can get long and we can target that weak swing high. Okay, so yeah, that's basically as simple as we use change of character. But obviously, when we combine that with multi-time frame analysis, supply and demand, etc., that is how we can increase our strike rate of using it. Very quickly, the same applies to if you're using this for reversals. So let's say price is bullish with the swing structure, right? Making a series of higher highs and higher lows. Now, let's say we come into a really clean supply level that we like, resistance level, whatever your strategy is, and you are anticipating a trend change. So you are anticipating that bearish reversal. Now, what you can do, and the safest thing to always do, is to wait for this swing higher low. So this being the most recent swing low. You just wait for that to be broken, right? Because then once this is broken and we get a lower low, that trend change is now confirmed. Okay, now we have that confirmed bearish trend change, and you can wait for price to pull back to form that lower high. Now we can get short. That's the safest way to do it. But of course, we don't have to wait for that. We can anticipate that reversal beforehand by looking at that internal change of character, right? So price takes out that minor low, that internal low. We then get that internal lower low, that change of character, wait for price to pull back, and then we can look to short and we anticipate that trend change. Okay, but of course, like anything, it's not 100% strike rate. We can get that internal change of character, we can get short, right? But then what can happen is this is still a strong low and a strong high, right? Sorry, a weak high until it's taken out. So when the market is bullish and we're trading to the upside, yes, we can get that change of character there and we can anticipate the reversal, like what we were expecting to happen over here. But there's no guarantee because this is still a strong low, right? So the odds are that this strong low is going to be protected and we're going to continue to the upside. So if you do get short and you're trying to trade that reversal, you see that change of character. But then if you see that bullish change of character again, you have to take that message from the market that actually this low is going to be protected. It's likely the higher low is now formed, and now we can target that higher high again, right, and take out that weak high. So yeah, just kind of that's how we use change of character. But you just need to know that, of course, it's not 100% of the time. Now, before we apply all of this onto the charts, one other thing we need to look at is actually, how do we map this on candlestick charts, right? Because we're not just going to be looking at line charts. So kind of two main ways you can do this. Both ways, we're always going to draw structure from the wicks of candles, okay? So wherever you draw your swing high and your swing low, we're always going to draw it from the wicks of candles. But the difference between the two types is what you need to see for a break of structure to have occurred. So for type 1, when you draw your structure from the candle, the wick of the candle, you need to see a candle close above that swing high, okay, for there to now be a high, for there to be a break of structure. Now, this is a bit more of a conservative way of mapping your structure because it's going to take a lot more money, right, to actually get price to breach that high and to stay and to maintain above that high and to close above that high. So here you can see where price spiked above it. Actually, it was just what's called a liquidity grab, right? It grabbed the orders behind that high, but it failed to close above there. So for me at that point, that would not be a higher high. That would not be a swing high because it didn't close above until we get this closure here. Now, the second way is type 2. This is a bit more aggressive because we map structure the same way from wicks, but we only need to see price literally just wick it for there to be a break of structure. So as you can see, this is the exact same price action, but you can see how the trend changes a lot more quickly. It's a lot more aggressive. You get those turning points a lot sooner because as soon as price breaks that high, that then gives us our higher high. So then if we look back, where was the lowest point that caused the high? It was this point here. Okay, so that becomes your swing low. So you map that. Then price breaks that. So now we're bearish. So we're playing within this range here. But then price moves up and then it forms a higher high. So you can see how that's a lot more aggressive. It can potentially get you into trade sooner. But it can give you a lot more full signals where you're viewing liquidity grabs as trend changes, okay? So for me personally, the way that I use these, I use both, which, okay, you may be thinking, right, give me a simple answer, but I always use both. So I use type 1 for, what should be here? I'm doing this little diagram, which hopefully makes this explanation a little bit more simple. So I use type 1 mapping where I want to see a candle closure for swing breaks of structure. So when I want to know if we formed a swing high or a swing lower low or whatever, I need to see a candle close above that high low. So as you can see here, these are the two type 1s there and here, because they're my swing breaks of structure. I want to see a candle closure at both these points to confirm those higher highs. Now, where I use type 2, so where I just want to see a wick break, I use those for the changes of character. So on the internal structure, I'm happy just to see a wick break there to know that I've had my change of character. Now I know the pullback's starting, and now I know maybe the pullback's ended, and we can get that next higher high. Okay, so hopefully that makes sense. So that was the theory. Like I said below, there should be a PDF link in the description below if you want to save these and go back over them. So let's hop onto the charts and apply this. So what we're going to do is we're going to go through a bit of price action on the 4-hour chart. I'm not going to do like a full-on long walkthrough just because this video will go on for hours. But we'll just look at a few kind of random bits of price action. yeah, and I'll just show you the way that I kind of apply that theory that we just gone through. And hopefully it will make a lot more sense. I went through it at a reasonably quick pace. Some of you who kind of trade this way, super simple stuff. Some of you who don't, it might be a little bit confusing. But hopefully, as we go through this now, you'll kind of see my thought process, how I look at everything we've just discussed, and you'll see how simple it can be. Obviously, watch this video as many times as you need to. So let's just zoom into this section of price action here. So my camera did just cut out there, but hopefully I can edit this together. So right now we're on the charts. What I'm going to do, just zoom into kind of a random bit of price action. And I'm just going to just talk through, I guess, that process that we just looked at. And hopefully this will start to make quite a bit more sense. So as we can see, right, on the 4-hour chart, price is making these series of higher highs and higher lows, and then we take out this low to switch to a bearish trend. So let's kind of just go from this point onwards. So as we get this break of structure here on the 4-hour chart, all right, we'll just mark that out as our break of structure. Now, where is our swing high and a swing low? That's basically what we always want to find out. What swing range are we playing within? And then everything from there on, right, follows. So as we get that break of structure to the downside, our swing high is the highest point that took out the swing low. So we trace back. Pretty obvious in this case, it would be that high up there. Now, after we get a break of structure, what do we expect? We expect a pullback on the time frame. How do we know when that pullback is likely to start? We get a change of character. So where is the change of character? But if you look at price action, ignore the color of the candles. That's irrelevant. What you want to be looking for is those counter trend movements where the next candle fails to break the low or the high of the previous candle, right? So in this case, we're bearish. We want to look at where do those candles stop breaking the prior candle's low. Here's the first point, right? We get that pullback, but we continue bearish, right? We get another pullback, and then we continue bearish. And then we take out that internal lower high to form an internal higher high, right? So that's the change of character we're looking for. So when we see that, that gives us our signal that there is now a bullish change of character, right, from that inside bar. And now we have the internal structure switching bullish, which is aligned with that pullback starting. How do we know when that pullback is likely to finish? Swing leg is likely to have started. Purely just thinking about structure here, right? Don't have multi-time frame analysis just yet. Not looking at supply and demand, not looking at liquidity sweeps, none of that stuff. Purely just simple structure. We look for a change of character back to the downside. So we have this bullish movement up, we have a pullback, we then have that internal higher high again, which means we now have that internal low there, right? Zoom in. That now becomes a low. So then when price comes down and takes out that low to form a lower low, now we have that change of character to the downside. The internal structure is now bearish, which means it's aligned with the swing structure. So now that gives us a really solid signal that the lower high has likely formed. And now we can look to get short as price pulls back into supply, right? And then where do we target? We target at a minimum that weak swing low. Why is it a weak swing low? Because it failed to take out the swing high, right? It failed to do its job. And then we get short, target there, and potentially further, okay? That's it. That's as simple as it is. That's the process I follow. Pretty much, obviously across more than one time frame, which we'll get into in a bit. But yeah, that's it. So then we get our break of structure. Now we need to know what's the next range we're playing with it. So where's our swing high? Pretty obvious in this case. So just mark that out. It's the highest point that took out the low. What do we expect after a break of structure? We expect a pullback on that time frame. How do we know when the swing run is over and that pullback's likely to have started? We get a change of character. So here, this is just a very minor pullback, right? And then all of those candles break the prior candle's low. So for me, this is the high that needs to go for there to be a change of character. Okay, so that confirms kind of the pullback started. Now, how do we know when that pullback's likely to have ended and we can catch that next lower high? We look for a change of character to the downside. So where does that happen? Well, if you look at the price action, we had a movement up. That's a pullback there because that's an inside bar. But then all of these candles break the prior candle's high. So that is all part of the up move. Then we pull back and then we take out that low. So now we have that internal change of character, right? The internal price action is now bearish. It's back in line with the swing trend or the swing range that we're within, right? That's the swing high, that's the swing low. We've had the pullback. We've now had the bearish change of character. We're back in line with the bearish swing trend. So now we can look for shorts, right? Price pulled back into supply. Boom, we can get short, catch the lower high, and target that weak low, right? So on and so forth. And that is literally it. You just always want to know, where's my swing range? Where's my swing high? Where's my swing low? What is the internal structure doing? Is the internal structure currently against the swing structure? Then that means it's likely pulling back. And then when it realigns with the same trend as the swing structure, then you know it's very likely that the pullback is now finished. The lower high may be in place. And now we can then target that weak swing structure. Yeah, that's it. I mean, I don't want to go through every bit of price action here. Let's just look at a few kind of more interesting, I guess, examples. So here we're still bearish, then we get a pullback. Let's kind of measure that pullback. How big is that? So yeah, over 40 pips. So on a 4-hour chart, for me, that counts as a swing pullback. So for me, I would mark that out as a break of structure. Okay, and then we are playing within what range? Well, that would be the swing high because that's the highest point that took out the low. And then obviously that's going to be the swing range we are within. So this is obviously where we get a reversal with the benefit of hindsight. But let's see how, how I would read this in a live market. Okay, so actually, let's do this. I wasn't going to do this, but let's do a little bit of bar replay. Let's do it on this example just because if we do it for everything, it would take forever. But we'll kind of finish up on this, right? So we're clearly bearish. We pull back, we break structure, right? So this is our current swing high. Now, we don't really know where the swing low is going to be until we pull back, but we've had the break of structure. What do we expect after break of structure? We expect a pullback. How do we know when the pullback is likely to start? We look for a change of character. So you see how all of these candles break the prior candles low? That's all part of the down move. But then with this candle here, it's an inside bar. Just got a little indicator that makes it a white candle. But essentially, you can see that this candle here failed to take out this candle's low. So that's part of the pullback, right? So now we know that we have a minor low. So move it along. Now price has taken out that low. That now means we have a minor high here. So I'm literally, if I'm looking for that bullish change of character, I'm waiting for this high to get taken out. And then I know that I have that bullish change of character and we can potentially anticipate a pullback starting. So let's move this forward. Okay, now we get that high taken out. That means we've had a bullish change of character. So now I can look for a pullback into where? Into this swing high up here. Okay, so the expectation, purely just looking at structure and purely just looking at one time frame, the expectation at the moment is that price will not trade higher than this swing high here. Why? Well, because technically it should be a strong high because it took out a low. So if we're to remain bearish, price can trade all the way up here and then it can go as long as it doesn't breach that high. Okay. But we've had a bullish change of character, so now we can look to trade this pullback back up and towards the high, okay? So price pulls back into demand, we get a nice movement up. That would be a great area to look for long positions, right, to play that counter trend pullback. Now, as price starts to pull back, what I'm looking for this entire time is I'm looking for price, as it's pulling back, to have that bearish change of character. So the internal structure realigns with the swing structure, then I know that a lower high is likely to have formed, and then I can try and trade that short. Okay, so what do we have here? Price is still bullish. Okay, we're just starting to get a bit more corrective, but we're still bullish. Okay, now we've had that bearish change of character because we have taken out this low. Okay, so you can see how price moved up, it pulled back, it went up, it pulled back, it went up, and then we got that internal lower low. So now the trend or the internal structure is in line with the bearish structure. We can look for shorts. Okay, now we pull back. Okay, now what happens here? You see, this is a warning sign because we move down, we form a lower low, internal lower high, an internal lower low, but then we take out that internal lower high. So what's happened? We've had a bullish change of character. So that gives us a warning sign that potentially, we're going to move up. At a bare minimum, I would expect this high here to get taken out, to get run, because it's failed to do its job. It's failed to make a lower low. So at a bare minimum, I would expect that. But generally, when this happens, especially right at the top of the range, this is usually a warning sign that it's going to fail and we are going to form that higher high. So now you can look for longs and then boom, we anticipate that trend change and now prices change trend. So then at this point, all right, you start looking for longs or pro trend longs and we get price there trading there to the upside. So yeah, I mean, I'll tell you what, we'll look at one last example. Let's look at reversals. They're usually a bit more interesting and then we can look at the continuation from there. So price is clearly bullish for quite a while. And then this would be our swing low down here, right? Move this out of the way and we get that breaker structure to the downside. So let me zoom in into here. So price now switches bearish. So obviously we're trying to anticipate that lower high to get that next bearish trend change, right? So price, we get a breaker structure. What do we expect after a breaker structure? We expect a pullback. How do we know when the pullback started? We get a bullish change of character. So we get that bullish change of character. Now we could just straight away, if you trade supply or whatever, look to get short from here, and that's absolutely fine. Maybe we want a little bit more confirmation. So how do we know when that pullback's likely to have ended and the next swing run is likely to have started? We wait for the internal structure to align with the swing structure. The swing structure is obviously bearish, so now we want to wait for the internal structure to switch bearish. So we come into supply, we pull back, we go in, and then we take out that minor low, right, which is down here. So now the internal structure, just draw it a little bit more accurately, you can be really aggressive and take the inside bar. Well, let's just take that minor low there. Right, now we have that bearish change of character. So now what? Now all systems are aligned, all systems go. We pull back into supply. Everything's there. Boom, we get short. Where do we target? At a minimum, that weak swing low. Why is that a weak low? Well, because it failed to take out the swing high. Okay. Then we get our break of structure and we now get a lower low. How do we anticipate when that pullback's likely to start? Well, we get a change of character. So you see how we take that minor high, right? Take the low, take the high. That is our bullish change character. Let me get rid of all these lines because it's getting messy as hell. So we get that break of structure. Okay, here, break of structure. Then we get that change of character as we take that minor high there. Then we pull back into supply. How do we know when that lower high is likely to have formed? We wait for the internal structure to switch bearish. So we take that low out, we get bearish, pull back into supply, right? And then short at a minimum, that low there, right? Then we pull back. How do we know when the pullback's over? We wait for that low to go. See, this is a minor low there. We get that bearish change of character, pull back into supply, boom, we're off. Now, obviously, you can't anticipate how far price is going to go. No one knows how far price is going to go, but that's when we start to bring in multi-time frame analysis, supply and demand, and we can start to do it, and you just follow it on. Again, when is this swing run likely to end it? Because we dump for ages, but we never get a bullish change of character until when? Until boom, then we get the change of character. Okay, pullback's now started. How do we know when the pullback's ended?
All righty. I think you get the picture. And at some point, trading like this is a lie. Nobody trades like that. You're trading to a point. You're not just trading blindly on one time frame. So that's why I don't want to continue listening to that sort of nonsense, because really you have your target before you enter your trade, right? And change of characters and all that stuff is great. But if you have multi time frames that you're using, they're kind of going to line up, right? So for this particular pair, I'm just going to use EN. We haven't traded it. Well, one person traded it illegally, but anyway. So if we're looking at this pair and this on the weekly chart, we're climbing, right? I'm just going to use this next because all this gibberish in here is a complex pullback, right? It means absolutely nothing in the larger picture. So when price gets up here, what I'm looking for is for this price to pull back, right? Now, of course, I'm selling here, but I'm only selling because we got to pull back. This was a low. This is a new high. This is a higher low. And this is a new high. All right. Some people don't view this as a new high, but I'm just telling you, this is a new high. And whenever I'm confused about it, because you got wicks and candle bodies, I just break out the old line chart, because the line chart ain't never lied to me. People lie all the time. The line chart tell the truth. And I put my little measurement tool here, and we broke that high. It's pretty simple. So if I'm looking at this on a line chart, there's probably going to be an imbalance or something in this area, right? If it wicks past or breaks this low, there's probably going to be an imbalance in this area. I don't necessarily have to guess. Like, it doesn't really matter, because this is where your trading plan and all that good stuff comes in. We know that this is your new swing low, right? We know that this level is your new swing low because this high was broken and this is the higher low. So if I fibbed this entire move from swing point to this new high and it's pulling back, I can expect that we pull back. Here's my golden zone. Here's my 78. So inside of those 2 points, I can probably find some imbalance, right? You see how this little red candle, let me make it a little bigger so everybody can see. So you see in my zone here, I have a imbalance from the wick of this, the top wick of this red candle to the bottom wick of this green candle. That happens to be within my golden zone. Down here, before I get to my 78, I have equal lows. So there are a couple of different areas of interest. I don't have to know 100% which is which. This is probably going to trade up a little bit at the start of the week, but even if it just traded straight down from this point to this point, I hit my goal per my trading plan. Now, what I'm seeing a lot of times is you'll get in this trade and it'll start doing what it does, which is going back and forth. It ain't breaking highs, it ain't breaking lows, it's consolidating. It's been 3 days. And the people get trade fatigued. But in reality, when you enter this trade and you put your stop loss or your hedge and you put your take profit, you're hands off. You don't do anything. You allow the trade to do what it's supposed to do at this point. And that's where a lot of the issue comes in. At some point, when you start trading a particular strategy, you have to allow that strategy or that trade time. And unfortunately, we as a trader, we don't control that time that it takes for the trade to play out. And sometimes I will see things in the chat, and people say things or they ask about the direction. And I'll put little eyes, or I might say something that to the effect of allow it to play out or whatever, and I think some people take that the wrong way. I know everybody doesn't trade like me, and I'm not saying that my style of trading is the best style, and everybody doesn't have to trade my style. There's several people are successful trading their own styles. All I'm trying to do is call your attention. Chances are I've probably seen this trade from a higher time frame than you. So I understand, doesn't matter how many times this thing goes back and forth, it's coming down. I understand that because, I've seen the higher time frame. So, if I'm pointing you in a direction, it's because, hey man, like I see this bearish order block and it's going to pull back. Yeah, it got stuck, right? It has to break through this garbage. So, on these lower time frames, this might frustrate you, this pullback. Because man, you're like, man, we already went to this level, we pulled back. Why are we pulling back again? To get you out the trade. Because you don't have any patience and you don't need to make this money because you don't believe that this trade is pulling back to this zone. I know it's pulling back to the zone, but you don't believe that it's doing it. So you'll get out the trade or you'll close it because of some lower time frame fake signal. And all this is saying is, man, if you had entered, you saw this push up and this pullback and you would enter this trade, or you got this order block and you would enter this trade. You're in, man. Your stop loss is here or wherever you're putting it, you're in the move and you're targeting this area. The problem with this is this happened on February 11th. And in your mind, you're like, man, bro, it's been 11 days and I ain't got paid yet. The market did not pay me for this 164 pip move in 11 days. I'm finished. Now, nobody in here goes to their boss after 11 days and quits because they didn't get paid, because they know the pay schedule is every 2 weeks. But you'll quit your trade after 11 days, because you're spoiled or whatever. That's fine. Like everybody's free to trade however they trade. If the trade don't play off in 10 minutes, everybody can cancel their trades. All I'm trying to suggest is if you see a trade setup, the trade setup is valid until it's not valid. So if you look at this structure, all the noise in here is noise. But if you're looking at this trade on the 15-minute, you got plenty of reasons to get out the trade, right? because you're down here on the 15-minute chart, which you really have no business on because you didn't take the trade based off the 15-minute structure. But if you're going to trade like this, it's going to be difficult for you to hold the trade. Or if you're going to look at the trade like every hour on the 15-minute chart, you're going to see plenty of structure breaks, plenty of things that make you scared. And that's just not going to help you, man. I don't know what to tell you beyond that. But in my opinion, if you're going to trade a swing style of trading, it's imperative that you develop helpful habits, right? You have to develop habits that assist you in holding a trade, right? And as a beginner who's trying to swing trade, or you're trying to hold your trade for 100 pips or 200 pips, you have to stay off of those lower time frames, right? As a beginner trader, if it were me, I would be using the weekly and the 4-hour chart. You can use those 2 time frames and you'll make $1 million. And you don't see a lot of the lower time frame stuff that scares you out of the trade, right? If this trade consolidates before it hits your TP, it happens sometimes. Sometimes you get in a trade that does that, and I hate that. I hate that you have to sit through it. But me personally, I would rather sit through this trade and win this one trade than lose 6 trades that I got into after I got out of this trade because I'm impatient. Right? If you're still blowing accounts or you're not achieving your goal, and I hit my goal every week, I got to side eye you. The only difference, the only difference between me and you is I have a level of patience that you may not have. I mean, I'm in a group that we call trades, and we win trades every week. Right? The good, the bad, and the ugly. The patience is the only difference. Patience is the only difference that I see. You either have it or you don't. It's hard to trade with no patience, especially when we're not the ones in control of the market moving. So structure is the number one thing to me that you have to understand, right? You have to understand the structure piece. And after that, you have to be patient with it. Here's a double top, there's a liquidity grab right here. There's a liquidity grab. After the liquidity grab, we break structure. We break these lows, that change of character, whatever you want to call it. This push all the way down. We haven't pulled back yet to the imbalance. That has to happen, but we just push down. Everything over here is noise. Everything that happened in between this low and this over here is noise, because we got to pull back to this imbalance before we get to the next step. And the next step, maybe we push down and make equal lows and buy up. Or maybe we push down and eventually break this low. So it's all a matter of you being patient enough to take that buy to here. Maybe you want to hold it to here, or whatever. But because of that liquidity grab, I'm expecting this high up here to be respected. So if you're in this buy trade and you took the buy trade from down here, and when it gets here, you're going to have 150 pips or 170 pips or whatever it is, take the trade with confidence. Once it hits your TP, now your account is bigger and you look for your next opportunity. Maybe the next opportunity isn't with EuroCAD. Maybe it's with a different pair. But to me, it's all the same song. And you start from the higher time frame, and you have an order block, and you have expectations. If you do the same thing every week, you're going to get the same results every week. Do we have any questions over market structure? Please Please be honest because if you don't get the market structure piece, bro, it's hard. It's hard out there in them trading streets because as soon as you get in that position and get mowed, you know, you your confidence takes a hit. And there's nothing wrong with all of us go through it. We've all been on the wrong side of that trade, when that trade started waterfalling against us. And to me, there are simple or more simple ways to kind of see it. If you're using multiple time frames, at least two, most of the time you should be on the right side. Because if this weekly is saying this is a bearish order block and we got to pull back to that order block in order to sell, then what I understand is by this red candle breaking the low of this green candle, when it pulls back, we're at least trading the equal lows. And if there's a trade in there, if it goes back to your golden zone here and trades to equal lows, it gives you your 100 pips. There's an opportunity for you to be successful. Now, if you try to add sauce to this, or get jiggy otherwise, and you get wrecked, that's on you. But the trade setup, that provides you your trading plan number, it's there. So we have to kind of be able to control ourselves and stay, covered within the lines. And if you can do that, I don't care. Every week there is a pair, whether it's a fast moving pair or a slow moving pair, that's going to pay you what your trading plan is looking to get paid. There's a move there. Maybe it takes 7 days instead of 3 days. Can't control that. But what is going to happen is you're going to get your money. Anybody have any questions?
Todd, yeah, I had a question for you.
Yes, sir.
I'm still struggling a little bit sometimes when it comes to looking at, I can see what like breaker structure looks like, but for the life of me, it's like sometimes with change of character, it looks like breaker structure
So
to me.
what's the difference?
So change of characters when say like for instance right here with CAD JPY, we got that long green wick right here. And
This right here?
yeah, this is not change of character right here because this is just consolidation right here. But if let's say,
I can't see where you're marking.
oh shoot, I'm sorry, I thought I put it right here. You see it now?
No, can y'all see it?
Nope.
You talking about right here?
I can't see yours either.
I can't see hers.
It's not letting me do it either.
I'll tell you what, I can pinpoint it, Todd. You see where it's spelling out Canadian dollar, the A in Canadian dollar and dollar? No, right down the
Right
bottom.
here.
Yeah, the green wick. Yeah. So let's just imagine that is like change of character, right? Even though I know it's not right now because it's just consolidating on that end. For me, is a way for me to recognize change of characters like after the fact, like if he started to go into it a little bit, so I know I'm gonna have to rewatch this video. But I struggle to recognize like change of character.
So listen, you see how
Todd,
you see how there was
no, I was gonna say, can you go back to that wick right there? The wick, yeah. Can you draw a line? Draw a line at the bottom of that wick. So because price did not close below there, close candle, then that high where Todd line is at the top, the first line you drew.
I know this one.
Yeah. So that's not considered a swing high because price did not close below that wick. Or well, see, Todd Todd is saying because it closed below the body if he uses his lines. But wicks are for me, wicks are bodies on lower time frame, right? So price did not go below that wick. So for me, it wouldn't be a swing high because price did not close below that wick. I don't know why I can't draw.
But this is what I get it. But this move down, right?
Yeah.
Move down. You had a change of character when we broke the structure, right? You see that? Like this move down.
Yep. I see the break of structure right there, like that third red bearish candle down.
Right, but here's where people get in trouble because this entire, if you look at the entire move, right, and we probably have to go up a time frame. This entire move down broke this low, or we change of character with this low, probably on the monthly or maybe the 2 monthly. This is going to be a change of character. So at this point, if you're looking at that super high time frame, all you're expecting is a pullback back up into this imbalance. But in this little example we have, you had a high, right? There was a high right here, the top wick of this candle. And if we go down to the 4-hour, you're going to see it. And then you had the market trade down and trade back up and broke that high, which was your change of character as far as price going back up, right? You got your change of character. All this is a pullback, right? So if I fibbed from this low to this high and you get this pullback, it's probably going to be about 78%. And then the market trades up, right? It trades up into this order block. And then you get a push down. We have not broken this low. We have not broken this high. So everything after this is internal structure. We're either going to push through this low, which it looks like it is, or we're going to push through this high. So just based off of the way everything is set up now, I would look at least challenging or breaking this internal low and pushing towards this low based on what I see. But I don't have to argue or guess at this level because my trade will take place from wherever it stops here, wherever it stops in my golden zone. And I can just drop down here to see if I see an imbalance. So you see the imbalance right here. So let's just say we take a short trade from here. I can just take this short trade it back to this equal low and get almost 200 pips. And I don't have to be in the trade or argue with me or Kim or Andrew on whether we're going to break this low or not. You see what I'm saying? Eventually, we are going to break that low because the JPYs are stronger than the rest of the currencies. And it's going to be like that because that's the way your president wants it. He wants a weaker dollar. We're getting it. And these prices will continue to push down like we discussed for months. But the point is, instead of you having to argue how far this is going to go down, all you have to do is plot your entry for the sell to equal lows. You see what I'm saying?
Oh, yeah.
And I think many people might get caught up in that same sort of thing that you might be talking about on a higher time frame. You need, when I say people who trade need to focus on what's in front of them, right? So in this leg of structure, we broke lows. For me, these are structure. This is a break of structure right here. This is the low, we broke it. All we're expecting, just like your boy said, when you break structure, we should get a pullback. So some people are going to say you fib from here to here. Some people are going to say you're going to fib from here to here, right? Instead of getting caught up in that, go up. Go up to the weekly, bro. You ain't got to argue with nobody. Now you fib this weekly candle. You get your pullback and you take your trade. The 4-hour already shows you where your imbalance is. That's an imbalance. Did that imbalance break structure? Yes. That's going to be a meaningful imbalance. Price is going to hit that imbalance and react. When it hits that imbalance, got you a trade. We got to trade back into this imbalance. Is there 100 pips? Yes. I consider that money. I mean, I think a lot of times we over complicate things as a trader. You know, like maybe we're like, oh man, maybe if I take this trade, it might hit this imbalance and go higher. But on the higher time frame, you just ignored the fact that it was a weekly bearish order block below your moving average. So, you know, to me, we got to take the trades that are in our face based on our 2 time frame analysis. Once that trade is over, take your profit, sit on the sideline. Don't overcomplicate um, the system or whatever. If you're ever in doubt, stop using the candle, use the line chart. Because then when you look across, you're gonna say, hey man, did we break this low? Yeah, we broke it. We trading back up. Yeah, we traded back up. You know what I'm saying? So if you get confused, use the line chart, bro.
Okay.
You trade like me anyway. Just
Mm-hmm.
use the line chart. It's not
Okay.
gonna lie to you. Kim gonna lie to you. Todd gonna lie to you. The line chart ain't.
Hi, Todd. So I wanted to just interject because I think explaining the difference between break of structure and change of character is also something that I am relearning. Um, so to me, the way I have reprocessed the information is break of structure can happen within, I would say, like the trend, right? So like every time it breaks the previous high, every time it creates a new low, it's still an uptrend. And then when it's changing character, it's changing the direction of the trend. So it will initially have to break structure for the previous low and then create another lower high and then another lower low. So now you're looking at a downtrend, which to me will be defined as the change of character. So
I
I
agree
don't know
with
if that
I agree
helped
with that.
him.
I agree 1,000%.
Okay, so that's because, I'm getting back in. So that's what helped me understand the difference is when we're shifting, I would say the bias would be the definition of the change of the character. So I just wanted to say that.
But
Thank
Gracias.
you. I understand the difference of it, like the technical, like I could definitely explain it to someone. I think for me, it's more so just recognizing like the candle, the candles and whatnot when that is. It's just a little bit more homework for me to do.
So when it's happening, so like for this weekly chart, right? It to me, it did create a lower high, but it did not create another lower low. So I think right now we're in between whether or not it will be a downtrend or uptrend. As you stated, it's still consolidating. So
And that's why I was trying to say, because people will look at this. I don't know why the annotation not working now. It just popped up on the screen, but people will see that where Todd had the first line at the top as a change of character. But for me, it's not a change of character because all this, you can't see what I'm doing.
Hey, Dylan,
Yeah.
it's a change of character, and I get it. Kim, what I was
That
pointing out was on a lower. Okay, I know. I guess I shouldn't do that. Okay, so when I was pointing out this high, I'm not pointing this high out in terms of me looking at it on the weekly chart. There's candles in there. There are on the 4 hour because you're not trading the weekly chart. You're marking up the weekly chart, but you're not actually taking your trades on the weekly chart. So when you mark up your weekly chart and you go down to the 4 hour, there's where your high is. Did we break it? Yes. We double topped and we pulled back. Like that's why I mark. There's your high right there. Price came back up. It played around. It played with its food. Then you broke your high. Double topped, pulled back, Now we're getting out of dodge. So that's when I'm looking at this on the weekly chart. I'm looking at for that candle. That's a whole week of trading right there. That's not just a candle that has a long wick. That's a whole week of action. Does that make sense?
Mm-hmm.
Kim, you understand why that's why I said that was a change of character right there.
I get what you're saying, and I think I get what you're saying. Mm-hmm.
But I mean, I think I don't know. And maybe
It's
I see it.
it's the verbiage. It's all it is the verbiage. You saying it. You saying it's a it's a change of character, but it's on the 4 hour. It's just
So for me, because I'm more of a trend trader, like I wouldn't be trying to trade that back up because I know that it's likely going to not go up as far as I think it is. So
Well, I'm going to trade it up because it's over.
I
mean,
know I get it.
look how many pips
But
that is, man. Come on, man. Y'all got to quit, man.
yeah, I'm
This,
just telling.
well, I get it, but I think we have to be
I'd rather
realistic.
wait for price to come to me, and then I'm just not gonna do it.
But
I just do it.
All it is Kim is maybe
I'm a more cautious. I'm a more
but
patient
500 pips
person.
is being cautious, y'all.
I
Come
mean
on.
it's a position. I mean, you guys are arguing over time frames, and
That's what I'm saying.
both of you are correct depending on the time frame that you're talking about. I mean, Kim, you seem to be approaching it for more of a long range trade. You know, I mean, the long range trend. You're correct.
Actually, I am more of a swing trader than Chad.
Are
And
you?
there's nothing wrong with that,
Well,
but
if you are, why would
that's
you
what's
not
frustrating.
just trade right here?
Because it's now when I'm
How can
telling
you
you,
miss?
I have trained myself that once the shift has happened, I trade the trend. That's just how I trade. It makes it much better
Are
for
you
me.
trading off the weekly chart though? Or I mean, I get it. If you're position trading, yes. But nobody, are you taking trades on the weekly chart, Kim? Are you
I'm not
taking
taking trades on the weekly chart, but I look at structure on the day. I look at structure on the daily. I'll look at the weekly to make sure I'm in alignment, but I'm mostly looking at the daily.
see, Dylan?
It's,
We
Uh-huh.
let my girl get us in this exchange, you know, and she ain't even been trading in like 2 years, 3 years.
shut up.
How you gonna come and do that there, Pips and Dip?
First of all, I don't appreciate the shade.
Listen,
Okay.
no,
What I was trying to
I'm being facetious, but
I think I was just trying to answer sir's question because I think you deviated when you was like entry and here and here and here. So like just basically explaining the difference between break of structure, change of character, and how to see that. So for me, with when you were looking at the weekly, I am unsure on the overall direction currently, right? Because it's creating lower highs, it's creating lower lows, but it also didn't break the lowest low. So I don't know if the overall direction will be sell or if it will be a buy.
okay.
That's what I was trying to identify. Whether you catch
You
it
don't
100 pips
you
in
don't need to
between.
know that though
No, I
at this
know, but
point.
you don't. But he's asking the difference between the two. So that's all I'm explaining. I'm not explaining how many pips you can catch in between. I'm just explaining the difference between identifying break of structure and change of character.
Well, I know I'm not confused because there's a head and shoulder. But listen, for me,
Mhm.
this right here tells any trader what's going on. There's a low. We came and broke that low. We broke that low. Now we pulled back. Now I'm looking to seek some action down in this area. For me. And I know everybody doesn't trade like me, but
And I agree that swing low was broken, right?
yeah.
And then if you go down to the daily, because I would be looking for some form of structure, because I know that impulse moved to the downside. And then wait a minute, hold on. Wait. And then I know it's not going to see it, but then it's not letting me see it. So, I mean, it's not letting me do it. So based on structure,
Do I need to zoom in?
so I can see the candles. That's what I need to, right? Okay. And then bring it down some. Okay. To the left of the C, or yeah, I mean, yeah, right where you just pointed down just a little bit. Because there's a drop, base drop, right? There's a
Right.
drop,
It's base.
then there's daily pullback on the buy, and then there's another drop, and then it's a drop all the way. So
Oh, drop, base.
no. Right there. Where that wick is, see the wick to the left? Okay, so price dropped there, pulled back, and then dropped again, right?
Uh-huh.
So that can be an area that for me, I would see that because I can definitely see it on the lower time frame, but I can see it on the daily that's going to be some form of structure, right?
Okay.
So that is where I would be looking for price to come back to.
It did.
And it did, and did. And then that's what I would be looking to sell it from the 4-hour or 1-hour time frame.
To break the low. Your thought process.
Then break those lows, correct.
Okay.
'Cause
I'm
it's
tracking. I agree 1,000%.
This is why I don't know what the debate is about.
The debate is about I'm not buying it up, but Todd is. That's the only difference.
Well, listen,
once I see structure,
to buy a retrace of a weekly candle. I mean, it doesn't change
Sean,
thing though. I mean, you're both saying the same thing.
I get it, but this is where I can hear where he's confused, because now once he sees a change of character, and yes, it is, you can buy it up, but if you don't understand market structure to the fullest, this is, I know that's how I used to get confused until I just started trading the trend. I was confused all the time.
Well, I think
Todd is Todd, and I consider myself an advanced trader. Like I can buy that up, yeah, and see where I'm going because there was structure there. But for somebody who's still trying to learn, and I don't think Delaney's a beginner, but for beginners, like that can be confusing.
well,
That's all I'm saying. That's all I'm saying.
And this is what I'm saying. You don't have to trade this up at all. You can wait until it gets here. You can wait until it breaks that order block. You can wait until it gets here. All I'm saying is, if you understand where you're taking your trade from, then you just wait.
Mm-hmm.
Like this might not ever buy up to this level. You might not ever get this entry. But you have to be okay with missing that trade setup. Maybe this just buys up to this supply zone and sells. So, it just depends on where you are as a trader. I would not have called this particular trade for a buy. I think there are probably better setups. I like UJ a lot better, than this trade anyway. But it's the same sort of setup. But the difference is I can get 100 pips to the zone with UJ. But if y'all remember, I'm the dude that was saying that UJ was going to sell after it broke a 3-month high. Y'all remember that?
Yep.
Remember me saying we're going to break the high of this candle and then we're going to sell and we're going to go down to the low. And everybody was, oh man, the Todd smoking crack, man. So it doesn't matter if people agree or not with your personal analysis. Like everybody is going to say that you're smoking, and then 1,000 pips later into the trade, they're going to never say that they were the ones smoking the crack, But the problem is you stick to your analysis and then you trade what you see. It's many times that you think something is going to happen, but the chart doesn't play out to go in that direction. And that's fine, because you don't have to be right in order to recognize, hey man, like what I thought was going to happen didn't necessarily happen. So now I need to change my bias because we broke this high or we broke this low. If you understand the basics of market structure, you're going to win a lot more trades than you'll lose. And the reason why I'm so heavy on the line charts are because where I think the confusion comes in is when people start telling you got to have a whole candle close above this high or above this low. Come on, bro. Either we broke the high or we didn't. And the line chart is going to show you that we either did or didn't. And if you're consistent in the way that you evaluate those things, you're going to win and lose at a consistent rate. And you can lose 6 trades or 7 trades and win 3, and you're still profitable. That's all that I'm saying,
All right. So I got a question. This is just to set up for every week when you guys are putting out the weekly order blocks. Question I have is based off of, like, let's say we go to the weekly chart for you, Jay. You just stay on here. So with looking at this, I can see some bearish order blocks. At any point in time, let's say, let me find one on here. Okay. This bullish order block right where in between November and 2025.
This one?
Yeah. So if I was looking at this on a weekly order block, I'll be looking at this like it's still a bullish trend or bullish, like I'm looking at this like a bullish order block.
Okay.
Right.
Before you got this action right here.
Right. Before any of that stuff.
Okay.
Happened. So when you guys put those up, like, okay, this week we're doing bullish order blocks, or it's a bearish order block on UJ. Help me understand when you guys are talking about the market structure, because that's the only part. Every week I'm trying to kind of come up with just a fundamental step-by-step
Okay.
how I approach the market.
Well, let's talk about it there, buddy. All righty. So if this, in which it should have been, you would have marked it up just like this, right?
Mm-hmm.
And you would have expected price to trade into your zone, 2078, and then a buy, correct?
Correct.
It didn't happen.
Correct.
Market comes up, runs these highs right here, then it pulls down right into your zone, and you get your reaction, your buy. How many pips do you think that buy is? Enough for you to cash out?
Correct.
So, yeah, this stuff works every time.
Okay.
And here's the issue and the problem with people as traders. If you had programmed a computer program, it would do this every time, and you get paid all kinds of riches. The problem with people are we start making up stuff, and we start adding our sauce to something that doesn't need any sauce.
Sure.
We have to take our trade and take our money, and we move on to the next trade. And that's the only way that we're going to find the requisite security in trading, right? The only difference between what I'm doing and what somebody is doing at their job, when you go to your job, if your boss says the job starts at 9, you clock in and you sit down, you don't go and cuss people out at work, on random. Well, if you do, you're getting fired. You're following those rules that they set for you at work, the work norms or whatever. Your trading should be the same way. Even if you're having a bad day, you don't switch up things at work. You might be more quiet or more reserved. You might put your head down at your desk. You might call in sick, take the day off. the trading should be the same way. When you come to the charts, even though your emotions are different, right? You got beat up yesterday, you had a bad day. Today you show up and you're supposed to do the same thing that you do any other day. And for me, it starts every week. I go look for the weekly order block. It's either there or it's not. I can't make it up. If it's there, I analyze it the same way that I analyze it every week. And this week, I already got my marks on my order block for this week. I do expect price to trade up into my zone, and I can take a sell trade.
Gotcha.
Now, here's the thing. Many times UJ don't give you your entry that you're looking for. Sometimes UJ don't pull back and just keep going. You can't force that entry. It's either going to pull back here and give me an entry or it isn't. And if it doesn't, maybe CAD JPY is my second option. You see what I'm saying?
Mm-hmm.
If you keep it there, it's so simple. Now, some people, and this is what Kim is talking about, well, Todd trades this up. I do. I trade that up many times. But, when I'm calling these trades in this group, I go with the safest option, or I've been going with the safest option. So maybe I wouldn't call this up because it's kind of tight. It's kind of right at the 100 pip mark. Maybe I wouldn't call this trade for a buy. But once it gets here, I would definitely call the sell. And that's the difference.
Well, you saying that you traded back down, you trading back down to the low of that candle?
Well, yeah, to me, again, I'm using multi-time frame analysis. To me, we're trading down here, bro.
Gotcha.
I mean, the only reason we ran the high of that candle is because we coming to the low. So once I get into the sell, I can just hold this. Is Aiden on this call? I remember telling, hey, dude, we're trading to that low. But it doesn't matter. All that is Mox Nicks. You can hold this for as long as you want, as long as it goes to that low, or you can take your 100 pips and you can bounce. What I suggest for most people is to take your pips and go to the house. It's just like trading to me. Like the guy was explaining he was explaining what the change of character was or break of structure on that one time frame. That's not realistic. Nobody trades like that consistently. You're going to lose a lot of money. All we're doing is trading until we run out of money. But if you have a goal and you trade to that goal and you get out of the market, then you have some consistency and you can build your account over time. So in a matter of weeks, you go from $100 to 10K. And you can take your time. Then you can trade up. Like you can change what you're risking once you get to whatever amount that you want to in your trading account.
Sure. That's my only question. Like, based on, I know you guys talk about market structure, and then different order blocks on the market structure is you trade it the same. So even if it's an uptrend on the weekly UJ, but you get a bearish order block, you still trade it the same way. Am I saying that right?
Yeah, to me, nothing changes, right? I know, like when you get this bullish order block and the market is pushing up, when we trade down to these moving average, if we don't break them, we're going higher. In this case, we broke the moving average. We came back and retested. We're going lower. Everything that's happening in here is still respecting the structure, especially with these order blocks. This was a bullish order block. You never got the tap in until it came here to tap in, and then you traded away from it 300 some pips. So
Gotcha.
Only thing that we have to do is stay on point. We mark up our zone. It either comes back to our zone to give us an entry or it doesn't, because maybe it takes 5 weeks for this thing to eventually come back up here and give us an entry. Does that make sense?
Mm-hmm.
Anybody else got any questions? And I just want to re-say this. You know, I think if y'all been in this group a while, y'all know me, and I'm not trying to offend anybody or embarrass people. You know, I get it. Trading is difficult. It's not something that just anybody can do. I kind of stress the things that I know have worked for me and many other people, and I let people kind of find their own way. What I do understand though is if you're doing one-on-ones with me and you're doing one-on-ones with Kim, you're wasting your time. Or it's not that you're wasting your time. Let me rephrase that. You're lengthening the time it's going to take for you to gain an understanding. We don't trade the same, right? Doesn't mean that my style is better than Kim's style. It means that my style is different from Kim's style. So if I'm telling you and I'm pointing out certain things for you to look at and do, and Kim is telling you certain things to look out and do, it's going to cause confusion before it ever gives you any clarity. Now, if you've traded Kim style for a year and a half, and you're successful doing that, and you're interested in my style, and you come and try to learn it, you're going to have more success because you have experience, and you might understand some of the concepts or some of the things that I point out versus some of the things that Kim points out. And where I speak about order blocks, you know, Kim is going to refer to as zones. Not that she doesn't know that the supply zone or demand zone is an order block, but she's going to refer to them as a supply zone or a demand zone, right? We both talk about imbalances. Maybe her approach towards imbalances is a little bit different from mine. But if you're trying to go back and forth, if you're listening to what I'm saying, and then you're listening to what she's saying, you're going to be confused because it's different lingo. Does everybody understand that? So I think we have to choose how we spend our time wisely. And on that same note, you know, I talk to Kim all the time offline. Coming up as a trader, man, like, we don't understand who, like, the people who don't spend countless hours watching YouTube videos. I don't know any other way. You know, when I came up with Dez and Alicia, we in Ruby's group, and we were always sidebarring and on YouTube and watching videos because we didn't understand, you know, what we wanted to understand. So when people don't have that same hunger or that same drive, it's kind of confusing to me. Like, I mean, I'm thinking, like, how is this person ever going to learn, or how do they expect to learn or pick this information up if they're not, like, on the charts like that, if they're not fiending for it? I don't know any other way. I only know how it made sense to me, or how I made progress. And that was by eating as many YouTube videos as I possibly could. And eventually you find people on YouTube that explain it in a way that you can digest. Maybe I explain it in a way that doesn't go down smooth. Like, it doesn't really make sense to you. So maybe I speak of a concept, or I talk about something on Saturday, and you say, you know what? That dude, you know, I can't really stomach the way he's talking about it. I need to go find a video that makes more sense. And then when you start looking at those YouTube videos, somebody is going to have a way of explaining it to where you can digest it pretty easily. And then you save that person's YouTube page, and then you kind of look for your information via that person's YouTube page. And there's nothing wrong with that. But my fear is that you're not being fed, or you're not being fed in a manner that you're able to easily digest the information. And then you're not doing any homework where you're finding somebody who can explain it a little bit better or differently.
I mean, I'll say this, personally, from the first time I talked to you to today, it was like Chinese arithmetic. Not because I didn't understand trading, right? To some degree, it's learning what these other concepts is and how to put a new framework together, right? So you told me to go look at ICT video. Now I see all of this stuff, but the first time you showed it to me, like even with the moving averages you just said right now, I didn't catch that the first time you said it to me, but I just caught it today, right? How you're using your moving averages and also how you're trading back to the lows or the highs of the candle. See, those, it's like, it's the what's the word?
Nuance.
It's the nuance, but it's the repetition. So
Yeah.
after you get the one thing, then you're not focusing on it because you're seeing it, and then the next thing you can see it because you almost heard everything else, but now you picked up the new thing that is helping add to the picture. So this ain't been easy to digest the information. It's just hearing it over and over again, but finding a way that's consistent, not so much finding a way that's consistent, sticking to it, but then having a consistent goal, that's something too, I think, to reach for. Because again, if I've heard on your call, Kim call, Andrew call, everybody saying go for 100 pips. So I'm not even thinking about going for nothing more than that when it comes to trading, because it's like, it doesn't make sense for me to try to go further than the 100 pips. It's how do we set up getting the 100 pips more consistently? Now that's what my trading plan is at. I'm not thinking about reaching for lows on other time frames, different things like that. I'm looking at what's the most effective way to get to the 100 pips with the setup.
Which is cool. But I also like the way you said, because I refer everybody to ICT because that's where I learned it or where it made the most sense to me. But I think the key is whenever I regurgitate what I think ICT showed me, I'm probably not going to hit every point that ICT hit because some stuff that he says is not significant to me because I already knew it, or maybe I had an understanding of it already. And maybe I reiterate portions of it that I didn't understand before he explained. And you as a new trader coming in or a different style trader coming in, maybe when I explain it to you, I leave out some portions that he hits on. And when you go listen to it from him, you'd be like, dang, why didn't Ty just say X, Y, and Z? Like that, ICT made it so simple. And to me, that's the importance of me giving out the source because he explains everything. It is just whether or not it makes sense to you as a trader or not. And I agree with you. Many times, if you look at the video again, or you the information multiple times, you're going to get deeper understanding of it the next few times that you see it or hear it. And I think that that's the benefit of the group, and that's the benefit of the way that Kim explains something or Andrew explains something, because we all will continue to learn and get a deeper understanding of trading over the months, the weeks, or whatever. Like Andrew has some double flat system, and he explains internal, external liquidity, all that good stuff. And there is a time and a place for all of that. But if you're a new person, it's overwhelming. And that's why I try to give you that one place that I learned it. The ICT 2022 mentorship is going to teach you one style of trading. It's going to teach you order block, displacement, and imbalance. That's all that on those 41 slides, that's exactly what he's teaching. Order block, displacement, imbalance, right? You get an order block, you get displacement, and you break that structure. Does it have an imbalance? Yeah. That's where price is going to trade back to that imbalance, and you're going to get that reaction. So if you understand those very basic concepts, you will be able to make a lot of money eventually. But it's just over time. You have to kind of allow those concepts to fester and then develop. And your understanding of those concepts is what's going to, make you successful, over time. And it just might not happen for you in 4 months. It might happen for you in 6 months. Somebody else might get it in 3 months.
One last question before we done. When you're talking about your moving averages and your order block breaks through that, are you saying you're looking at the body of it to break through order block? Yeah. I'm asking questions.
No, it's funny because ICT doesn't use moving averages.
Right.
Oliver Velez is the moving average guy, but definitely you want the body closure above or below your moving average. Now, if we're going to talk about moving average, we got to talk about time and price. So for me, I like to focus on moving averages, around the if I'm expecting a big move, right? Maybe it's a 3-month candle closure, maybe it's a 1-month candle closure or whatever, and I'm expecting price to go in the opposite direction. Let me go to the monthly so I can just kind of look. Okay, so you see how this monthly candle is? My goodness, this is a great month for you, Jay. Okay, so as it stands in this itty bitty month of February, this candle has dropped 700 pips, right? And it's probably going to drop right into this imbalance, right? It's probably going to hit this piece next week. And for the month of February, we're going to get this long candle. And I'm going to expect a pullback. I'm going to be buying next month. I'm going to tell you, I'm looking at this candle. I'm going to be buying next month. I'll be buying UJ or maybe even GJ. I don't know how many pips GJ has went. Now, what I'm going to be looking for, what's going to be the telltale sign for me, right? This looks like the area that I'm going to look at targeting by the end of the week. I'm going to be looking for price to turn and cross over my moving average. That's going to be a crucial key for me to buy this 400 pips or, however many pips it's available. It's going to be about 400 pips or so, according to that 700 pips. So I will need this thing to buy back up to this area to get a 50% pullback. If I get 78% pullback, I'll probably be trading it back to this level, just based on that chart that I saw. And I know some people are probably confused, and I get it, but all I can do is take you back to last year. When did we catch that move?
That was like last week.
No, I'm talking about like at the end of the year. Okay. All right. So in January of last year, we expected in December, we had a bearish order block, 2-month order block. We expected price to buy up. So we knew that at 1 January, in fact, January 2nd, because you can't, the market doesn't open on the 1st of January, but you're going to get a push to the north side. So on January 2nd last year, we got into this trade. You see how that pushed and closed on January 1st? 1,700. So this pulled back on January 2nd. Where is January 2nd? There you go. January 2nd, 1 a.m. This was our entry into this trade, into this buy trade. And price exploded to the top side. Now, I didn't hold it for the 2,700 pips. I didn't know it was going 2,700. I figured that it was going to pull back. But that, to me, that's the best use of the moving average when you're expecting a decent move, right? So, yeah, you could have looked at this and said, hey, there's a liquidity grab. There's a push up and a pullback, and we're going north. You could have used it like that. But it's a lot easier just to use the moving average when you're expecting price to change directions to go for a distance than you know, than those lower time frames. So most of the time, I don't really pay these very much attention until I'm expecting that end of the month change of direction. So I'll look for the last week of that month to get my crossover, and then I'll look to take the trade to go the opposite direction.
Hmm.
But you'll never hear that on an ICT video. That's not an ICT concept.
Hmm.
We had the same sort of deal on GN. I think we took GN on January 1st this year. But look, y'all, it's I think it's been a pretty decent month. You know, maybe you haven't won every trade, but hopefully you're at least seeing, you know, if you can see it, it's only a matter of time before you can actually trade it. So hopefully everybody is at least seeing the move that they have lined up or they expect from the market. Is anybody having trouble seeing the move? Nobody. Well, that's great.
Todd, this is Rosa. And I can see my move. And like you said, my problem is with that garbage in between, I get scared and I get out. And then by Friday, it hit my golden zone, or like, because I put my mark, I do the weekly and I put my mark in there. And I'm noticing that it does by Friday, it done did exactly what I said it was gonna do. But by Wednesday or Thursday, I got out because I got scared. Yeah.
Oh my God. Rosa, you've been overtraded for 4 years. You gotta listen. If I were you, like, are you using the US 30 or are you trading pairs now?
Oh, I'm still using US 30 and
No,
NAS.
no,
And like I
listen,
was
I
in
know
that
why you did
sale. I
that.
was in that sale for NAS, and it went
Yeah.
all the way down.
Oh yeah,
I
now
had
and
that
all of
marked, but I got out before it did it.
Yeah,
I got
well,
the
I
Friday,
kind
I
of
got a little
understand.
bit of the pips, but I lost a lot because I got scared and
Yeah,
closed it out.
and in my opinion, maybe your lot size is too big for your comfort level.
No, I went down to the point. Oh, I used to use the big ones and to get my thousands, but I went down to the 0.01 because I said I'm trying to do just the 100 pip move thing. So I got in too early, but I was still able to I had it marked down though to where it stopped at. But I got out and then because I did take a second position, I did get 100 pips, but I could have got a whole lot more had I held my original position where I only took out $30 from that because I got scared and said, well, I got my 100 pips because I took that second position higher. And then I just say I can't take a chance of it going back up again because it was going up and down, up and down. But
Yeah,
I did have my location marked where I knew it was gonna go. But the fear of that going back and forth got me. And I gotta learn to hold the trade, like you say, just to say this is where I'm going with it and leave it alone. I can't get over that fear yet. I'm working on that.
well, I think that I guess probably time is going to be your best weapon. But if you like, your concept work, Rosa, like all of your trades have been like you've been successful. So I just think that if you can't hold a trade or if you got scared out of your trade, then it might be lot size. But or you just, why don't you just not look at it? Like once you set your parameters, just leave it alone.
Yes, that's what I know I have to do because I'm constantly looking and I'm constantly checking. And then when I see, oh no, this look like it's turning out, you know, but I know that's what I have to do. I have to set the perimeters and just leave it alone.
Leave
And
it
that's what
alone.
I'm working on. That's my struggle I know that's my issue because I'm having really success as being able to market, get me a location, and usually it goes there. But I know what my issue is, and that's what I'm working on.
Yeah, I think I mean, you're one of the better traders as far as at least marking it up. I mean, I don't think many people, you, Leandra, y'all have it down. So I mean, I would definitely just say, don't look at it. If it scares you, don't look at it. If these pairs wasn't so easy, I would probably trade more indices, but the pairs are so simple that it just doesn't make sense to take the extra risk. All right, anybody else got anything? I sure appreciate everybody's involvement, man. And I think that this year we'll probably make a lot of progress, a lot more progress as a group. I think a lot more people are finding a more sustainable level of success. If you ask anybody, to include myself, we're always going to say, "Oh man, I'm not trading as good as I should be trading." So that's understandable. You're not satisfied with where you are as a trader. You always want to get better, but I think finding some stability, even if you're not like profitable every week, but you kind of understand what you're looking for and what you're looking at. To me, that's the crucial piece of the puzzle. Because if you can see it, eventually you will be able to execute the trade, right? First step is seeing it. And then once you see it, now it's all about execution. Execution might take you a few months, because execution is going to be more about discipline than anything else. And when you take that trade, when you pull the trigger on the trade, you have to trust that you have the proper stop loss / hedge and the proper TP. Once those things fall into place, it's a wrap. It's a wrap, because everything is automatic. You get in the trade, it's either going to hit your TP or hit your stop loss. And most of the time, you don't have to watch. You're not going to watch. You're going to get in the trade. Maybe you'll go do something. You'll go to work. You'll go do something in the yard. You'll come back and your trade will have TP. Many times those 100 pips go pretty fast. Whether you get into it and you go to sleep, or you get into it, you go to work, you come back and your trade is finished. So be encouraged. Don't take what I say to you personally. If I say something that offends you, let me know. I just want you to win. I want us to win, as a team. And I want us to get out of these United States as a team. Even if y'all don't want to leave the United States, maybe you'll eventually see that you need to leave the United States. Because why? There is no benefit. They're not giving you anything. You're not gaining anything. This isn't the best place to live. It isn't the safest place to live. It's not like they're not poisoning you. How come the Thailand's obesity rate ain't the same as the United States? How come we have the highest cancer rate of any developed nation? Those are all rhetorical questions, but it is what it is. All righty, good folks. If there are no questions, we can roll out.
Just to confirm, your meeting is on Tuesdays.
Yeah,
After.
yeah.
Okay. All right. Cool. Thank you.
All right, good people.
Thank you, Todd.
Thanks, Todd.